All right, welcome back to Yahoo Finance Live on this Monday morning. All three majors are in the green. Stocks continuing to climb. We are about to cross the one-year anniversary of the absolute COVID-era market bottom. Brian Sozzi, that means there is one word that everyone wants to say, begins with a B, rhymes with double. Goldman Sachs writing about it over the weekend. What's the deal?
Well, it's not Brian. It's bubble in this case, Miles. And this is a very long, extensive note out of Peter Oppenheimer at Goldman Sachs. It's the type of note you just bookmark and you go back to and you think about it during the week. So I plan to have more on this as the week unfolds. But anyway, this is Oppenheimer saying he does not think there is a bubble right now, despite more people searching on Google the word bubble. And we have that chart here. You can see more people now searching for the word bubble, which coincides with the market rally. But Oppenheimer says, no, we are not in a bubble. And he lists some pretty good reasons here. First and foremost, he says historically we have very low interest rates where you obviously you have people out there or you have investors out there taking risks, but doesn't appear to be excessive risks, at least when it comes to stocks. Next up, big companies. The big companies like the big cap tech that dominates the markets, they're dominating for a reason, points out Oppenheimer. And one of those reasons is they're dominating their sector and they're also producing large amounts of cash flow. That's a lot different than we saw in the late 1990s bubble where you had companies essentially trading at stratospheric valuations and earning no money and with no prospects to earn more money at some point in a future period. Also, too, Oppenheimer says he's not seeing widespread excess ownership of stock. So that is an interesting point, considering what we did see with GameStop and with a lot of retail investors in January, February, and I would argue we still continue to see it now. Again, Oppenheimer not seeing excessive ownership of stocks. And then last but not least, not seeing banks take really large risks when it comes to their balance sheets, and I would agree with that. You look at the bank balance sheets, JP Morgan, Bank of America, Goldman Sachs, are they taking more risk? Sure, but this is not the same type of risk profiles these companies were taking in 2008 and the late 1990s.
Yeah, look, we'll get out of here. I think the bubble thing is fascinating because really to me it comes from this place of, people want to be in the next Michael Lewis book, but guess what? Even if you get the bubble call right, even if there were a bubble, you're probably not going to be in the Michael Lewis book anyway. And in general, when markets go down a lot, most people lose money. You hedge the market so you lose less money than your peers in kind of bear event that we saw last spring. But it's not like a huge money maker per se. It can be on a very limited basis. But we'll table this conversation for a later time. Right, Brian Sozzi with really chart of the day. I don't know if we're going to do better than putting the tulip bubble, Mississippi bubble, and Bitcoin in one place throughout the rest of this week.